Hello, today I want to go through some problems relating to the conceptual framework, and you will see these in the homework and on the exam. I'm just going to dive right in. So we'll start with this one, and it says listed below are several statements that relate to financial accounting and reporting. Identify the accounting concept that applies to each statement. Number one. Which component would allow a large company to record the purchase of a $120 printer as an expense rather than capitalizing the printer as an asset? Well, normally a printer has more than a 1 year life, and so normally we would capitalize and depreciate. But because $120 is really an immaterial number, the concept that we're covering is materiality, and we would just expense it, because $120 is not material. Number two, Donald Kirk, former chairman of the FASB, once noted that there must be public confidence that the standard setting system is credible, that selection of board members is based on merit and not the influence of special interests. Which characteristic is implicit in Mr. Kirk's statement? Well, I'll tell you, it is a neutrality, and that's because the financial statements must be neutral. They cannot be leaning or favoring any sort of special interest or companies or sectors, or otherwise we could not rely on them. They would not be relevant. Number three, Allied Appliances Incorporated changed its revenue recognition policies. Which characteristic is jeopardized by this change? It is consistency. If they got to make sure that their policies are consistent and therefore making them comparable. If financial statements are not comparable from one period to the next, then they're pretty useless to the user. Number four, National Bancorp, a publicly traded company, files quarterly and annual financial statements with the SEC. Which characteristic is relevant to the timing of these periodic filings? This is called timeliness. We have to have timely statements issued with SEC in order to make them useful to the user. If the information is old, then it's no good to the user. Number five, in general, relevant information possesses which qualities? It possesses a predictive value and confirmatory value. It's also materiality, but that's a little bit separate from this. But it helps predict companies' future cash outflows, and it helps either confirm or change an external user's prior assessment of the company. Number six, when there is an agreement between a measure or description and the phenomenon it purports to represent, information possesses which characteristics? It is faithful representation. So basically what this says is that when you see a description or an amount of financial statement, it is what you expect it to be. So for example, if you see the term inventory on a financial statement, then it's understood by an external user to represent items that are intended for sale. It does not include cash or accounts receivable. Otherwise, it does not have faithful representation. Number seven, Jeff Brown is evaluating two future investment potential. Jeff's task is made easier because both companies use the same accounting methods when preparing their financial statements. Which characteristics does the information Jeff will be using? That one is comparability. When you have two companies using the same accounting methods, which usually is the accrual method unless it's a very small company, then you're comparing apples to apples. You cannot compare let's say, an accrual basis versus a cash basis company. Number 8, a company should disclose information only if the perceived benefits of the disclosure exceed the cost of providing the information. Which constraint does this statement describe? This is the cost constraint or cost effectiveness constraint. And it says that the cost of providing financial information should not exceed the benefit of providing that financial information or the financial statements. Okay, moving on. This is a different exercise, so that's why the numbers start again. But Jenna Acer is the sole owners of Acer Appliances. Jenna borrowed $100,000 to buy a new home to be used as their personal residence. The liability was not recorded in the records of Acer Appliances. So this is the economic, talks about the economic entity assumption, which says that the company and owners are separate entities and you do separate accounting for them. So if Jenna personally borrowed $100,000 to buy a new home to use for her as her personal home, then that liability cannot be recorded in her company's financial statements. Number 2, Apple Incorporated distributes an annual report to its shareholders. This is going to be the periodicity assumption, which says that allows the life of the company to be divided into artificial time periods to provide timely information, which says that the financial statements have to be issued at least once a year for a private company, but for a public company, it's going to be at least quarterly. Number 3, Hewlett-Packard Corporation depreciates machinery and equipment over their useful life. This is talking about the expense recognition, also the going concern assumption, but let's talk about the expense recognition really quickly first. If you go back to your reading, you'll see that there are actually 4 different approaches to recognizing expense. This particular example talks about basically capitalizing and depreciating over useful life, and that's called a systemic and rational allocation, and that's when you allocate the cost to specific time periods because that asset provides benefits to the company for more than 1 year and for the whatever number of years that the company decides to depreciate it. And so straight line depreciation is a systemic and rational way to allocate costs over a period of time. This also is part of the going concern assumption, because when you depreciate assets over a number of years, your assumption is that your company is going to exist in the long term, which is a going concern assumption. Number 4, Crosby Company lists land on its balance sheet at $120,000, its original price, even though the land has a current fair value of $200,000. This is going to be talking about the historical cost principle, and this is part of measurement, which is how much do we put on, what amount do we put on a financial statement for any given account. And there are 5 different measurement that a company can choose depending on the circumstances. When a company buys an asset such as a PP&E, such as land, then it's always at the historical cost, no matter what the fair value is. Number 5, Honeywell International Incorporated records revenue when products are delivered to customers, even though the cash has not yet been received. This is talking about the revenue recognition principle, and we recognize revenue essentially when the earnings process is complete or virtually complete. So in this instance, the products have been delivered to the customers, so therefore you do recognize the revenue even though you have not received the cash. Number 6, Liquidation values are not normally reported in financial statements, even though many companies do go out of business. This is talking to the going concern assumption. So liquidation values, you would only report those if you think that the company is going to be liquidated, which means the assets are going to be sold for less than what they're worth because the company is no longer operating. You cannot foresee the company operating at a profit or operating in the long term. So the going concern assumption says that we assume a company is going to continue operating in the long term, and so therefore we do not value the assets at their liquidation value. Number 7, IBM Corporation, a multi-billion-dollar company, purchased some small tools at a cost of $800. Even though the tools will be used for a number of years, the company recorded the purchase as an expense. This goes under the materiality concept that if a company purchases tools and they last more than 1 year, in general, you would think, yes, I'm going to capitalize and depreciate those tools because their useful life is greater than 1 year. However, for a company like IBM, and they buy tools at $800, that is really not a material amount, and so they're just going to expense it rather than capitalize an expense. Next exercise. In this exercise, we're going to state which principle or assumption has been violated. So number 1, the company purchased land 2 years ago for a price of $250,000. Because the value of the land has appreciated to $400,000, the company has valued the land at $400,000 in its most recent balance sheet. Well, we've discussed this a few minutes ago, that you cannot do that. When you acquire property, plant, and equipment and land, it must be at whatever you paid for it, which is the historical cost, regardless of what value it is. Number 2, Atwell Corporation has not prepared financial statements for external users for 3 years. This violates the periodicity assumption, which again allows the life of the company to be divided into artificial time periods to provide timely information. This also ties into timeliness. The assumption, which states that we need to issue financial statements at least once a year for a private company and at least quarterly for a public company. Number 3, the Klingon company sells farm machinery. Revenue from a large order of machinery from a new buyer was recorded the day the order was received. This violates the revenue recognition principle, which we only recognize revenue when the earnings process is complete or virtually complete. Receiving an order is not virtually completing in the earnings process, because if that was the case, then companies could easily inflate their sales by having someone order, a large quantity and then canceling it the next day in order just to meet, some financial statements criteria, profit criteria. Number 4, Don Smith is the sole owner of a company called Hardware City. The company recently paid a $150 utility bill for Smith's personal residence and recorded a $150 expense. This violates the economic entity assumption, which states that the owner and the company must be separate, including all their accounting. So you cannot, a company cannot pay for the owner's personal expenses and then expense that on the company's financials. Number 5, Golden Book Company purchased a large printing machine for $1 million, a material amount, and recorded the purchase as an expense. Well, this violates the expense recognition principle, because for a large printing machine that lasts for more than 1 year, has a life greater than 1 year, and it is material, because they tell us that $1 million in this case is material, must be capitalized and then depreciated over their service life. Number 6, a compliance company is involved in a major lawsuit involving injuries sustained by some of its employees in the manufacturing plant. The company is being sued for $2 million, a material amount, and is not insured. The suit was not disclosed in the most recent financial statements because no settlement has been reached. This is violating the full disclosure principle. If there's a potential for a lawsuit that's coming for a large sum payment that the company may have to pay out, the financial statement user should know about it, even though it hasn't yet occurred, through a disclosure.